I recall, in previous conversations with you that you've said it's actually the Eurodollar, the number of Eurodollars that are out there, their dollars or their US dollar denominated debt. And collectively, they're substantially more than the actual dollars inside the US. So a couple of things. I conclude that must mean that the relative strength of the dollar versus other currencies is highly influenced by what's going on in the Eurodollar market. That correct?
Absolutely. Yes, absolutely. So if you think back to the way the monetary system is designed, you have base money, which is the physical coins and the currency that we walk around with in our pockets. And then it's the reserves that's set at the central bank. All other money in existence is loaned into existence. Okay, so the base money is the only money that actually exists kind of physically. Everything else is a loan that's created, and that new money creation has an interest rate attached to it. And because of that, you have to have two things. The system has to grow, or there has to be enough velocity or interaction or circulation of the money currently in existence. And if money is flowing and money is circulating, then $1 can pay off or can service the debt on a number of different people's debt. But if it's just sitting there, there's not that circulation of money, and debts start to happen. So then, but if it keeps growing, then there's more money, and that kind of provides circulation in and of itself. And that is also why when we get into a credit crisis where supply starts to contract, loans aren't being made, it has a kind of a cascading effect where you get a crunch. And it's the design of the system that forces the central bank or whoever the monetary authority is to then come in and put more collateral into the system to recollateralize it. So the system, it's just important to understand that to survive, the system has to grow. Now, back about 30 years ago, maybe more than that, in the late 80s, early 90s, was the last time somebody that I can find, and if somebody has more info on this, I'm happy to take a look at it. But the last was Morgan Guarantee tried to measure the Eurodollar market. And at the time, at their best calculations, the Eurodollar market was 2 or 3 times bigger than the US domestic dollar market. Now think about how much the US dollar market has grown in the last 30 or 40 years, the amount of debt that's grown in the last 30 or 40 years. And then if you understand that the system has to grow in order to survive, then you also know that the Eurodollar market has to have grown over the last 30 or 40 years. So if it was 2 or 3 times bigger than the US market 40 years ago, imagine how big it is now, right? And I don't know how to measure it exactly. I wish I did, but it's huge, it's enormous. And the problem is when that Eurodollar market seizes up, or when that Eurodollar market stops growing and there's a credit crunch in the Eurodollar market, there is no monetary authority that has jurisdiction outside the United States that can go and put new dollars into the system. Only the US government and the US Fed can create new dollars. And so, it becomes a real problem. And it will eventually cascade all the way back to the United States itself. So the people that say eventually the US will have to put the whole Eurodollar market on its back, I don't disagree with that. But what I do disagree with is that it's going to hit the United States first. It's not going to hit the United States first because we actually can print the money. We can create the collateral. We can create the reserves necessary. The rest of the world cannot. And so it's it starts on the periphery and it works its way towards the core. But I think and I think that's kind of what led to 2008. It's what led to the repo crisis in 2019. It's what greatly contributed to the rise of the dollar in 2020. And now you see it rising again in 2022. And the one point I want to make sure I make, maybe you were going to bring this up at some point, but I have a lot of people that tell me, well, all the Fed has to do is come in and print again and the dollar will fall. And the short answer is yes, that's probably correct. If they were to come out tomorrow and say they were going to now do another round of QE and send checks to the citizens, et cetera, that would probably, in the short term, probably make the dollar fall, just like it did in 2020. But the problem is that now it's very, very hard to do that because of all the inflationary pressures. If they go back to QE now with inflation being very high, it's probably going to push inflation even higher, or has the potential to push inflation higher. Whether it would or not, I don't know, but it's just not as easy for them to do it now as they did 2 years ago. The other thing is, if you think about everything the Fed did over the last 2 years, helicopter money, sent checks to everybody, bought high yield bonds, did PPP bailouts of failing businesses, all of these things. And yet here we are, and the dollar is up 20% over the last year, or whatever the number is, maybe 15% over the last year. And so I think you have, and I can take it further back. If you go back to 2008, since 2008, we've had QE1, QE2, QE3, Operation Twist. We've had numerous bailouts, numerous stimulus packages. We had the COVID response. We dropped the money from helicopters. We had crisis at the Fed, where insider trading scandal at the Fed. We had all kinds of problems. And yet the dollar is 25% higher than it was in 2007, 2008, before all this began. So to the people that tell me that all the Fed has to do is print money and the dollar that's going to take care of the problem, well, it hasn't taken care of it yet. And they've tried pretty hard. And so it's not as easy to solve this problem as everybody thinks it is. And I think that's why we have the dollar where it is today, despite all the protestations to the contrary.
All right. So the visual that's conjuring in my mind here is, and I'm being a bit hyperbolic, but it's a pebble and a boulder, where the US currency market is the pebble and the Eurodollar market is the boulder. And you could increase the mass of the pebble by 50% or more, and it's going to be dwarfed if the size of the boulder decreases by like 5%.
That's absolutely. So while money supply in the US may be growing, global money supply or global dollar supply could still be contracting.
Great.
And this is part of the problem when you start comparing M2 charts and you show the great expansion of M2 in the United States versus the expansion of M2 in other countries. And even if you show it relative to the size of the base, or you show it relative to the size of the economy, because when the US prints money, they do it for the whole world. When the UK does it, they do it for England. When Europe does it, they do it for Europe. When China does it, they do it for China. But when the US does it, they do it for the whole world. So when you look at these charts, when you're calculating it, the dollar creation, you're using the wrong denominator. And so while it looks dramatic, it isn't nearly as dramatic as it is for the other currencies. And that is why you've seen the other currencies fall dramatically versus the dollar. Because while the US, you could argue the US dramatically increased supply, on a relative basis, the rest of the world created a lot more.
So this is why looking at the health of the rest of the world is so important, as you said, because if the rest of the world starts faltering, then you start having those issues that you were talking about, where all these countries that are trading in dollars, or even worse, have lent in dollars, they start being unable to either produce as much economic output as they did before, or these Eurodollar loans start defaulting, which means that that boulder is beginning to shrink a little bit, right? And that then drives the price of the US dollar higher relative to other currencies, because there's now fewer Eurodollars out there versus other currencies. And that sort of exacerbates the situation, right? So we have this danger of a cascading effect, where if the rest of the world starts getting into enough serious trouble, you get this cascade going through the Eurodollar market, the exchange rates go bananas, then money just starts seeking safety. As you said, people start trusting one another, rates start going higher, raising the cost of capital for everybody, which makes the situation even worse. So that's the big boogeyman here. And I think I finally, hopefully, have helped folks understand that.
Yes.
So you said in that case, you think that the US ends up drinking the rest of the world's milkshake. And I just want to clarify a bit what you meant by that. Is that just means that all the capital seeks the US market as a safe haven, and therefore, our financial assets weather the storm better because there's just such a massive flood of international capital in there? Is it something else? What do you mean by drinking the rest of the world's milkshake?
No, I mean, I think you described it very well. I think as this really heats up, liquidity is going to fall. And I think you're going to see other countries have to provide more liquidity. Japan is a perfect example. Everything that the dollar bears, for lack of better description, everything that the dollar bears say may eventually happen to the US dollar and why you need to get out of it is already happening in Japan, right? And they are already having to flood their market with new collateral and new yen in order to offset the rise in interest rates, to keep interest rates down. And so, I think this is going to, this is how you end up getting hyperinflation. Now, I actually hate the term hyperinflation because I think it's so overused that, especially with relation to the dollar, that it's kind of lost its effect. But the way hyperinflation happens is when you start printing your local currency and there's no external or international demand for it. And all of that money just stays in the US or in that specific country. This is where you can see things happening, again, in some of these smaller frontier countries where they have to print money to go buy dollars to service their dollar debt. But as they do that, they just end up increasing their local supply. But nobody outside that country wants that currency. And so it stays in the currency and it drives up prices and then the currency loses value. And so, I think this is going to, you can already see it happening in many places around the world. I think it's going to continue to happen. And so I think as that happens, again, there's going to be a lack of liquidity, but for the people who do have liquidity, I think they are going to seek a relative safety. And I think that relative safety is going to be found in the US and the US dollar. And so as that capital leaves those countries or those regions and finds its way into the dollar and US dollar assets, it deprives those regions and those countries of liquidity. And there's nothing worse for an economy or asset prices than a lack of liquidity. And so it's a squeeze, right? It's like a sponge, and it's full of liquidity. But as you squeeze it, all that liquidity leaves that area and it goes somewhere else. And I think as the world gets squeezed, I think all that liquidity goes into the dollar and into the US.
All right, maybe to murder my analogy, the boulder starts shrinking and the pebble starts growing.
That's right.
That's right.
That's right.
If you enjoyed this video clip, click here to watch another one you should like.